షెరియన్ గారు, రాజేంద్ర కుమార్ గారి ప్రొఫైల్ ఉందా మీ దగ్గర?
Sir, but he is not coming today. As
maybe he is engaged with any other work, I think.
Tomorrow he will come.
Okay.
Just now is informed, sir. Tomorrow is coming, sir.
Okay.
Today is reaching to Hyderabad, I think. So
okay.
Maybe it's not possible for him to meet the.
Sir, what about the speaker, sir?
Speaker already joined, sir.
Already joined. Okay. Okay.
He made a co-host also.
Right. Right, sir. Madam, I think it's just about 6 p.m. I think we can start. If the chairman sir is there.
Sure, sir.
We'll start the meeting, sir. We'll start the
Yeah.
Respected Chairman of Vijayawada Branch, CA Godavarti Srinivasarao. Today's resource person, CA V. Shankar Narayanan, Managing Committee members, past Chairman of the branch, fellow members of our fraternity. Good evening to one and all. We are delighted to welcome you all for the second day of 5 days virtual refresher course on practical aspects of GST, organized by GST and Indirect Taxes Committee, hosted by Vijayawada branch of SARC of ICAI. Hope yesterday's session was really value added to you with the excellent deliberations on the topic accounting and ledger maintenance by CA Ganesh Prabhu. Today, CA V. Shankar Narayanan is going to deal with important topic originating GST returns from accounting software and reconciliation statements and maintenance of ITC ledgers. Before moving forward, I request our Chairman CA Godavarti Srinivasarao to give his welcome address. Thank you.
Good evening, ladies and gentlemen, respected resource person Shankar Narayan sir, and my dear colleagues in the managing committee, Shrita Shirin ma'am and Rita Ravikishore sir. Welcome to the today's session on the practical aspects of GST. Yesterday we learned about the accounting entries and the intricacies of the financial and tax debit note and credit note and all these things. Now that it's time to learn about the how we have to originate the return from the accounting softwares. Basically, that is becoming a challenging part because if it is not automated, we are getting so many problems in dealing the things, and how we have to maintain the input tax ledger and how to claim and how to claim the thing, input also, and all these things. And also there is a reconciliation part. Most of the things we are confusing about the 1, 2, 3A, 3B, whatever the case may be. So I will have a detailed discussion about the Shankar Narayan sir, who is an expert in dealing all those things. And today, just now, I have a message from Rajendra Kumar sir that he is going to join tomorrow, not today, because of his hectic schedule. He came to Chennai now, and so tomorrow he is going to join with us. Without wasting much of your time, I request our Secretary Shrita Shirin ma'am to introduce Shankar Narayan sir to you all. Thank you, and over to Shirin ma'am.
Thank you. I'm glad to introduce our today's resource person, CA Shankar Narayanan. He is, regarding his educational qualifications, he is BCom, SCMA, and FCA. And he is a chartered accountant and cost and management accountant with 1.5 decade of experience in financial and taxation compliances spanning across diverse sectors, including bank, service sector, and manufacturing sector, with specialization in indirect taxation like GST, customs, foreign trade policy. And also, he is founder partner in GPVS and Associates, a Chennai-based CA firm heading the indirect taxation, compliances, advisory, and litigation practical. Regarding his role in ICAI, he is member of GST study group of ICAI, and he is master trainer of GST affiliated by ICAI, and he is contributor as a part of ICAI team in charge of preparing and updating background material on GST. His achievements as a resource person. He trained more than 2,000 chartered accountants and 6,000 plus finance and accounting professionals across the India on GST law and practice and indirect taxes also. And he is speaker and trainer on taxation at ICAI and Institute of Cost and Accountants of India and Institute of Company Secretaries of India and CTSTI and NACN and Regional Training Institute of CNDZ and ICT engaged in GST knowledge dissemination part of NITI Ayog initiative. Regarding other associations, he is member of Governing Council and Secretary of International Chamber of Indirect Tax Professionals, and he is member of Indirect Tax Committee of Hindustan Chamber of Commerce. And also, he authored various books on SENVAT and GST. With this illustrative profile, I request our resource person Shankar Narayanan to present upon the today's topic. Thank you.
The floor is open for you, sir, and you can do the things. Thank you.
Thank you, sir. Thank you, ma'am. Starting off with the office bearers of Vijayawada branch for organizing this. I should thank you upfront, and the IDTC also for taking efforts to draft a course on practical aspects of GST. Yesterday, I think Ganesh Prabhu would have taken you through the practical aspect of GST in terms of the accounting. I'm hoping that you are able to see my screen.
No, sir. No, sir. I'm not able to see that. You have to select the entire screen and then.
I've done that, sir.
I think it's not visible, sir.
So, sir, I'm not able to resume share. Somebody has taken my rights, I believe.
I know, sir. You are co-host. You are the co-host, sir, and as such, you have every right to share the things, sir.
Yes, I'm trying to, just a minute.
You just stop the sharing and again try to share, sir.
Okay. Yes, sir, I have done that. It is still saying resume share.
What's it saying, sir? It is saying resume share. Yes, someone is typing in the chat box that they are having poor audio quality. Actually, the audio quality is fine. You please check your settings at your end. Sir, in the share screen, are you sharing the particular apps window or are you sharing the entire screen, sir?
I'm sharing the PPT window, sir.
PPT window. Do you have any other option like share the entire screen?
No, sir. All I can see is
Sir, Ravikishore, sir, shall I make him host, sir?
One participant can share at a time. Only host can share. Right, sir. Give him host right, sir.
Sir Shankaran, sir, I'm giving the host rights, sir. Don't leave this speaker without assigning the host rights to me or any other person.
sure.
That is the, sir. I'm making you as a host, sir.
Okay.
Now you try, sir. First, you make me as a co-host, sir. Sir Ravikishore, sir, he can select the multiple participants can share simultaneously or one participant can share at a time.
No, sir. He should be able to do that. Why he is unable, I am not able to understand. Or else we can do one thing, sir. Chairman, sir, is there a copy of the PPT with you?
Yes, sir. It is there.
You can do one thing, sir. You may initiate the PPT and we can share it.
But I've never seen this happening, sir. We have been using Zoom for quite some time.
Yeah,
But
yeah.
how is it that I'm the host, I'm not able to share and it says paused sharing?
Let me try. Will I be able to share the screen? Just let me check, sir.
Please. Should I make you the host?
No need, sir.
Okay.
Somebody is already shared the screen na. See, Satish garu chesaru kada ippude. Satish garu mana PPT run chesaru kada. Ayan share screen chesaru. Share screen.
Okay, then we'll do one thing, sir. Allow multiple participants can share simultaneously. I have allowed that.
Okay.
Now, will it be possible for us to share?
No, it is still saying that.
Double
No,
click.
sir.
Sir, can I do one thing, sir? I will make you the host. I will make you the host. I will log off and log in. That is the only possible, sir.
Yeah, please,
Sir. Sir, now I think you will be able to share, sir.
No, it is still saying resume, pause share.
Okay, sir. Make our chairman host and you just sign out and sign in,
Yes,
sir.
yes.
My dear members, there is a small technical glitch from the speaker side. I request everyone to kindly bear with us.
Sir, I am able to do that, sir.
Yeah, that's perfect, sir. I'm thinking there is a problem from his end only. Actually, that's why I thought of trying the same in the beginning itself.
That's great. Yeah, someone was saying that even schools are doing the screen share. You may check the Vijayawada branch YouTube channel as to how many number of hundreds of videos are there. We are pioneers in that, and don't worry about the technical capabilities of Vijayawada branch. Sir, sorry for the inconvenience and for those words, sir. C.A. Shankar, sir, you please start your proceedings, sir.
Yes, sir. Thank you, sir. I think when we speak about GST, the immediate thing that has to come along with it is the technical glitch. So we have had that also. So it is very auspicious to have a technical glitch. Then only GST will be successful. Let's start off on that note. So the focus of today is going to be on the first few minutes. We'll discuss about the input tax credit.
Sir, your video is not yet started, sir.
Sir, he intentionally stopped the video, sir.
No, I don't think so. Yeah.
Oh, I'm fine with having the video, sir. I've switched on the video now. Yeah.
Please. Thank you, sir. Go ahead, sir. Thank you.
Okay. So as I was saying, the coverage is going to be on the areas of input tax credit, not the general input tax credit of section 16, 17 and all. We are going to discuss only the niche areas, the particular areas where we have to be careful from a compliance perspective and where we need to take a stand because there are still unsettled propositions in GST. And then when we are using an accounting software, I'm not going to lean on any particular accounting software. I'm going to give an overall view because we all would have come across various software starting from the complex ERPs to the homemade softwares which some of our clients might have. So when we are using it, how the data needs to be populated or how the data needs any further care, special care with respect to GST's expectation in the returns, and then the reconciliations, the latest introduction into the GST family. We have a new return being introduced or a new data point being introduced, I should say, which is called as GSTR 2B. Now that is going to become mandatory from 1st of January as it has been notified already. But for the period from now till 1st of January, we will have the trial and error time. So let us also understand what it is and how we are going to face it. And then the normal reconciliations that one has to do in line with the GST website, in our books of accounts, any control areas that needs to be looked at. And then finally, we look at the various kind of records that need to be maintained under GST, the accounts record registers that needs to be maintained under GST section 36 read with rule 56, as well as the key ledger or the key register, which is the input tax credit ledger or input tax register. That is what is going to be our agenda for today's discussion. Now let's look at the initial aspect. As I said, the key or the niche aspects of practical difficulties in ITC or practical issues that we might face in ITC. Situation number 1, where we will have both the taxable as well as exempted output. Let us look at a scenario where we are having a client who has both taxable as well as exempted. Now, when I use the word exempted in GST, exempted includes non-taxable, because the word exempted is not only meant for those which are wholly exempted. Exempted also includes the ones which are not taxable, the ones which are nil rated. So 2 subsection 47 of the CGST Act clarifies that. So exempted is not only what is wholly exempted. Exempted includes what is wholly exempted plus nil rated plus not taxable. So all this will form part of exempted. Now, why this we need to understand and appreciate is because some of us think that exempted is only what is exempted under section 11 of the CGST Act or section 6 of the IGST Act, and any non-taxable activity that we do, we are not apportioning the ITC properly. For example, a petrol bunk. In case of a petrol bunk, the ITC that is being availed, I'm not talking about the ITC on the oil or those items other than the petrol, diesel, which are coming under GST. Now, these are one-to-one correlatable input tax credits. Now, look at the common ITC, maybe a rental ITC, maybe a ITC on audit fees, our own audit fees or our compliance fees. Now, how are they going to avail this ITC? There is an argument that it is pertaining to a business where there is a non-taxable as well as taxable turnover. So why should I reverse? But actually, the expectation of section 17 subsection 2 is there has to be a reversal. Reversal must be done to the extent of that non-taxable turnover. Why? Because though the word used is exempted, exempted includes non-taxable. The reversal is mandatory. Now, how that reversal happens later during the presentation, we will see a macro level view. I'm not going to get into the details of it, just to give an idea. But this is one challenging area for input tax credit that we are going to see. The other key practical difficulty that we face, or how many of us have already fallen into the trap, is Rule 37. Rule 37 is that rule which expects us to reverse the input tax credit if we have not paid it to our supplier within 180 days. And the key question here is, what if we have paid it subsequently? If it had been paid subsequently, then how to manage it? Now, that is what is going to be discussed in the initial part. And then the major battle between input service distributor vis-a-vis a cross-charge mechanism. So on ITC, we'll see these parts first before we move to the other parts of ITC. Look at the case which I have put in front of you, a simple case. Messrs MMSW Limited, a poultry farm in Tirupati, Andhra Pradesh. It also has got a branch in Hyderabad, which is Telangana. Animal feed is procured centrally, and it is procured centrally at their Tirupati premises, and it is stock transferred to Hyderabad once in a month. What they are selling is poultry, which is live animals. Since all the outward supply is exempted, so the live animals per se are exempted from the purview of GST. They do not avail any input tax credit. Now, are they compliant with GST law? They do not avail any input tax credit. They file only an exempted turnover return. Now, are they compliant with the input tax, or are they compliant with the GST law? I've given the clues enough on the screen. Now, the aspect that one has to understand, because this is a practical case which we came to know, and later on we were able to avert a huge loss on the part of the assessee in terms of taxation. The practicality that one needs to appreciate and understand here is the stock transfer. Stock transfer of the animal feed happens from one state to another, one registration to another. Sir, I am not registered in both the places. Still, there is an interstate stock transfer. Fine. What if it is an interstate stock transfer? That is where the matter gets even more complex. Andhra Pradesh is the place from where it originates, and Telangana is the place to which the stock transfer happens. And interestingly, my output is live animals, which is exempted. But what is stock transferred is the animal feed. and animal feed is generally taxable at 5% GST. Sir, but I'm only using it for my exempted output. Correct. But when you are stock transferring animal feed from Andhra Pradesh to Telangana, are you not doing a supply? No, how come it is a supply? It is a supply under Schedule 1. Schedule 1 says any kind of such activity of movement of goods between distinct persons. Now, how am I a distinct person? You are in two different states. Whether you have a registration or not, you are making an interstate movement. Now, moment you make an interstate movement, Section 24 will come into picture. Section 24 will say you have to mandatorily get registered. So I should have got registered. If I have not registered so far, now I become liable to get registered first. Sir, I'm already registered. Then you come to the second part of the complaints, which is the stock transfer that you did, you are liable to pay GST. Now comes the next question. Sir, the stock transfer, I'm just purchasing it and I'm going to do a stock transfer. Can I do it at any value? Not possible. Why? Because the recipient, only if the recipient is entitled to take input tax credit. I'll repeat, only if the recipient is entitled to take input tax credit, whatever we charge in the invoice shall be deemed to be the open market value. Rule 28, second proviso. Rule 28 of the valuation, read with section 15, it says that if you are going to do any transaction between related person or distinct person, and the other party, that is the recipient, is entitled to take input tax credit, then whatever value that is charged in the invoice shall be deemed to be the open market value. For example, I am procuring the animal feed at 100. I am stock transferring it at 100. I am stock transferring it at 80. Second scenario. Can I do it at 80? Not possible. Because my recipient is not entitled to take input tax credit. Then what is the value at which I am supposed to do stock transfer? We have to go to Rule 28, as per which we have to do it at open market value. A very important compliance. Sir, but in this case, the net effect is zero. The net effect is not zero because Andhra Pradesh government has got the revenue. Telangana has not got the revenue, but the goods have gone to Telangana. Now, there is a bright chance that the notice will come from Telangana government saying you have moved the inventory, that is animal feed, into my state. Where is my GST? GST being a destination-based consumption tax, the question will come from Telangana government where at that time we will not be able to avail the input tax credit because the goods movement have happened and the time limit for issuing an invoice and availing ITC for an invoice for a previous year would have expired by the September of the following financial year. So we cannot do the firefighting for the previous financial year. Maybe for the just completed financial year or the current financial year, we can try to save the input tax credit, but not for the earlier periods. Hence, when we are looking at an assessee or anybody who has exempted output only, there also the ITC will have a role to play. In addition to that, any kind of stock transfer that is happening, especially if the assessee is going to be a person who is going to have only exempted output. I can even fit in an example of an hospital. A hospital located in two states, the capital goods, let's say a complex mission, an MRI mission. An MRI mission is stock transferred from one state to another. Now this MRI mission, is it not being supplied between two distinct persons? Absolutely, yes. It is being supplied between two distinct persons. We are supposed to follow the rules of supply, raise an invoice, stock transfer it at a particular value so that the other party can take input tax credit. This has to be reported as output tax liability. There the ITC has to be availed. Now all this will have to be taken care when the situation, practicality is when the output of this person is going to be having both taxable as well as exempted. Only when both are going to be there, my output is going to be both taxable as well as exempted or only exempted, be doubly careful about such kind of transactions. Now moving to the next aspect, Rule 37's expectation. Now Rule 37 is one rule where we have had a lot of deliberations. We will have our own interpretations, and in GSTR 9 and 9C we will have our own methodology of qualifying it, because what is the expectation of section 16 read with Rule 37 in essence is that whenever there is a failure on the part of the recipient to make payment to the supplier, within 180 days. Make payment within 180 days. If you fail to make payment within 180 days, for what? If I fail to make payment both for the taxable value as well as the tax value. So it is not only the tax portion, it is applicable both for the taxable value as well as the tax value. If I fail to make the payment within 180 days. 180 days starts from which date? Is it the date on which me as a recipient have booked the invoice, or is it the date of invoice? The answer is it is from the date of invoice from the supplier. So my supplier raises an invoice on 1st January 2020. The 180 days starts from 1st January 2020. Many a times what we have seen practically is, especially if it is a service invoice, and some of you might have an experience, we will have an experience because some of our audit fee or our services fee bills will face this consequence. We would have raised, they would not have even received, or it would have got lost somewhere in their office. The approving authorities table or somewhere it would have got lost. After 4 months, when we call them for reminder for payment, they will say, where is the invoice? Now we would have paid tax 4 months back. Now we give them the invoice. They are supposed to make the payment within the next 2 months because 180 days time limit has already started ticking. Now this has to be kept in mind, and this has some further repercussions. Now I'll continue with that example in terms of timeline. 1st January 2020, the invoice is raised. By let's say 28th of June 2020, which technically is the 181st day, I am not able to make the payment. I have not made the payment. Now what am I supposed to do? I am supposed to reverse the input tax credit. I am supposed to reverse the ITC availed on such invoices. Where do I show it? Where does it come in my GST return? This is your GSTR 3B table 4. This is where we are going to report the first part. What is the first part? I'm going to report my availment of ITC here. When I availed it in January, when I got the invoice in January, I would have shown it under all other ITC. That is the only place that is left for me because it is a B2B normal input tax credit. So I'm going to avail it in table 4, that is GSTR 3B, table 4, clause A, subclause 5. This is where I'm going to report and take the ITC. By June 28th, I come to know that I have not made payment. Now I'm assuming a situation where I have not made single rupee payment. We will further discuss the various possibilities. I have not made a single rupee of payment to my supplier. What am I supposed to do? For the month of June, when I am filing the return by 20th of July, I am supposed to reverse it and show it in 4B subclause 2. In 4B2, others, ITC reversal on account of any other reason other than rule 42 and 43, I am supposed to show it here. So first I need to ascertain my eligibility. I have ascertained the eligibility in January 2020. I have availed the input tax credit. So that is taken care. It is not happening in the same month. I have told you the timeline also. So January, I have availed the ITC. Now in June, I find out that 180 days have expired. I have not made the payment. So June's return in July, I am showing this as a reversal. So this is first part. Now here, a slight variation could be, sir, what if I have partially made the payment? Let's say I have made 50% payment. 1 lakh plus 18,000 GST is what is the invoice. I have made payment for 59,000 rupees. Now, can I assume that inside that 59,000, the 18,000 of GST is there plus 41,000 of basic value is paid? I will repeat. The GST on the total transaction is 18,000. The taxable value is 1 lakh. That is what the invoice says. I have paid you 59,000 rupees. Can I assume that this 59,000 includes the full value of GST of 18,000 plus 41,000 towards the 1 lakh? We can assume, but law doesn't allow us to assume. It says that both the tax value and the taxable value should have been paid. So it is not that 18,000 I will allocate towards tax value, 41,000 I will take towards taxable value, not possible. So we have to assume that this 59,000 is inclusive of GST. What I paid is inclusive of GST. GST to the extent of what? Only to the extent of 18% sitting inside this 59,000. So how do I extricate that 18%? Simple, 18 by 118. 59,000 into 18 by 118 will give us 9,000 as the answer, and that 9,000 will be deemed to be our eligible input tax credit, because for that only we have made the payment. So in this scenario, in my 4A5, I would have availed ITC on 1 lakh plus 8, 1 lakh on the corresponding 18,000 I would have availed. But now in June month's return, I will reverse 9,000 because I am eligible for 9,000. So I should reverse 9,000. So this is how partial payment should also have to be handled by us. Now here, the first challenge that I have seen, and what I would tell you also, is that many a times debtors aging is easily available from the books of the clients, but creditors aging is there. Some of the cases it won't even be there, because most of the time creditors aging will be based upon their follow-up. It will not be based upon a time limit. Whenever the creditor follows up repeatedly, they will pay. One. Second situation, they will have a creditors aging, but the creditors aging will be from the date they booked the invoice. They will never even capture the date of invoice. I'll repeat, they will not capture the date of invoice of the supplier. Any accounting package, this has to be made mandatory. The package may not make it mandatory. We have to inform the clients to make it mandatory. Else, Rule 37 compliance will have a practical difficulty. They have to do it. Only when they do it, we will be able to carve out data in terms of how much of invoices on which we availed ITC, which has crossed 180 days and for which payment has not been made by the assessee. Now here we will face different kinds of problem, because sir, he didn't pay within 180 days, but he paid within 210 days. What should I do? You are supposed to pay interest. You need not reverse, because we found it out today, and we found out that sir, he has subsequently made payments sir after 180 days, but he didn't reverse after 180 days. You are supposed to reverse after 180 days, and you could have re-availed the credit. Now this is the point that I am coming to. Now in Rule 37, Sub-Rule 4, there is a resounding provision which says you can re-avail the input tax credit. You can re-avail the input tax credit whenever you make payment. And the most important part is there is no time limit for such re-availment. I have received the invoice on 1st January 2020. I did not make a single rupee of payment till 28th of June 2020. I reversed the ITC in my June 2020 return. First part of the story is over. Now I am making the payment. Maybe it is a one-time settlement after the dispute is resolved. I am making the payment for that invoice in 2025. 5 years from now, I am making the payment in 2025. Can I avail the input tax credit? Yes, I can avail the input tax credit. That is what Rule 37 Sub-Rule 4 says. There is no time limit for re-availment of such ITC. So the word that is used in Rule 37 Sub-Rule 4 is re-availment or re-availing. If I have to distinguish between what is availing and re-availing in the light of 37.4, what we have done here is availing. Showing it as part of all other ITC is availing. Subsequently, in June 2020's return, I am reversing it. So this is giving away, extinguishing my ITC right. Now, in 2025, when I make the payment, I am supposed to re-avail the ITC. Can I re-avail the ITC? Yes. Can it be availed in 3B? Yes, that is the only way in which we can avail the input tax credit today. Is there a possibility for me to avail this overriding GSTR 2A? Yes, we do have. And that is the reason why, if you see in our GSTR 9 also in table 6, there will be a separate line to capture reclaimed ITC. Why would there be a reclaimed ITC specifically given in GSTR 9 is only for such kind of ITC? In 2017-18, that reclaimed ITC had little relevance. 18-19, you would have seen the relevance of that line increasing. In 19-20, you will see it even more. That is because reclaimed ITC is a situation where first you avail, subsequently due to non-fulfillment of the conditions of section 16 in terms of payment within 180 days, read with rule 37, you reverse the ITC either partly or fully, and subsequent to that reversal, you end up making a payment either partly or fully. To the extent of payment made, you stand eligible to take ITC. Now that ITC need not match with your 2A, need not match with your 2B. It can still be part of your ITC in GSTR 3B. This is how it has to be done. Fine, it is very straightforward. What is the complexity? The complexity is some of the assessees are doing it wrongly. How? They know that they will not be able to make the payment within 180 days, so they don't even avail the ITC. I'll repeat. They know that they will not be able to make the payment within 180 days, so they don't avail the ITC at all. If you don't avail the ITC, after say one and a half years, or let's say 3 years, when you make the payment, how will you call it as re-availment? Only when you have availed and you have reversed, then you can call it as re-availment when you are availing it while making the payment. If you have not availed it, and there is no question of reversal, and you are availing it afresh when you are making payment, then it may not be called as re-availing. Hence, you may not become eligible for that ITC. This has to be looked upon and educated to the assessees, because capturing this data on one end, the assessee will feel bad because we are asking him to reverse. But at the same time, we can also give them a positive view that, sir, tomorrow whenever you make payment, you become eligible. No? So what you do, if you know very well that in first day itself, I will not make the payment within 180 days, well and good. Report it in all other ITC, reverse it in the same month. I'm repeating, report it and reverse it in the same month. Because you know very well that you're not going to pay it within 180 days. But once you report it and reverse it, subsequent availment will be called as re-availment. But you have never reported it and you want to report it the first time. After having made the payment, you will not be eligible because it is not re-availment. Hence, this word re-availing in Rule 37 sub Rule 4 needs to be carefully dealt with. Moving further, the third question or the third point which I highlighted, which is to look at the major question of input service distributor versus cross charge. This is a very pertinent question only for those entities which have got multi-state presence. Multi-state for the purpose of making supply. So I am registered in 3 or 4 states. In all the 3 or 4 states, we are having offices, and all the 4 states we are doing outward supplies. Then comes this issue of how do we track the transactions that are happening between all of them. Now I've taken the same example. The ITC perspective can become a problem area in future, which is what I have taken here. The ITC problem that can occur is excess accumulation of input tax credit in one location. So how can it happen? In the same example of the poultry farm, which I took at the start of the session, the MMSW Limited, which is the poultry farm company, which has office presence both in Andhra Pradesh, Tirupati, as well as in Hyderabad, Telangana, they receive the audit fee invoice. The audit fee invoice is addressed to their Andhra Pradesh office, their Andhra Pradesh GST number. Now this Andhra Pradesh office, question number 1, can they avail input tax credit? You have to see it in the context of the example that I gave. Strictly speaking, they can avail ITC because they have done an outward supply which is taxable, no? The animal feed stock transfer, hope you remember that. So they become entitled to take ITC. Wow. Then can they take full ITC? No, they take only proportionate ITC. Fine. Now, whatever the proportionate ITC they take, that is where my question is. Are they entitled in full for the proportionate ITC? I'll repeat, are they entitled in full for the proportionate ITC? Why would I ask this question? I'm not getting into costing. Why this question is because audit is common for both the locations. audit is common and performed in both the locations or performed for both the locations, but the fee invoice is given only to one of the location. So what it does is the ITC gets accumulated in Andhra Pradesh indirectly. The tax payment to Andhra Pradesh governments get curtailed. Because you have availed ITC in my state, which means to the extent of exhausting that ITC, you will not make payment of tax to me. This can be a question. Then how do I give this ITC to the Telangana branch also? There are two possibilities. One, the auditor should be asked to raise two invoices. One on Andhra Pradesh, one on Telangana. That ends the matter. As an organization, as a company, it is only one. Two GST invoices are being issued for the audit fee. Is it logical? Is it illegal? It is logical. It is not illegal. It is right. Even in service tax era, we have seen it happening. And there is no provision in GST which stops it from being done. And once it is done, we will come out of this problem of accumulation of excess ITC where the department can accuse us at a later point of time. Or the second option is, no, let us not complicate it in our supplier's hand. Let the vendor, whoever is giving us the goods or services, let them do it in their own way with one of the entity only. We will manage it internally. Then the one who is receiving the service, which is the Andhra Pradesh branch, will have to get registered as an ISD because they are in receipt of a service which is common. They are in receipt of a service which is a common service. Once it is called as a common service, that common service related ITC, they cannot enjoy it in full. To whomsoever it is common, they will have to distribute. That is the essence of section 20 and 21 of the CGST Act. So they will have to distribute. For doing the distribution, they will have to get registered as ISD. So either split the invoices from the supplier end itself, or once you take the ITC, you will have to split it. ISD or cross charge. A call has to be taken. A practical problem that will arise, and especially when every state is fighting tooth and nail for their share of GST revenue. This problem can be a huge dampener in the days to come, where the state might say, you've got ITC, I don't have a problem, but why so much of ITC in my state only? Why this common input tax credit is availed in my state only? Why not this credit be distributed is the question that can come. And somehow out of 1.24 crores of taxpayers who are registered under GST, only 8,000 and odd are ISD registered. So ISD registrations are hardly 8,000 plus. We will see that growing in future when such kind of notices fly. You can avert this by either at the supplier end or by distribution of credit. Or the best thing would be common ITC. You may skip to avail the common ITC also. This decision is in our hands. As a person who is advising, we will have to take a call, but look at the issue and then in respect of a client, to which extent the client will be able to bear the risk or the reward, we can give the advice. So one more point that ITC will pose a practical issue. The next part that we are going to discuss is the GST ITC impact on gifts and samples, discounts, and transactions which are in the nature of any exchange or disposals, which ultimately result in exchange. Let's look at the practical parts of this. Now, on the first part, when I look at a gift or a sample, what is a gift or a sample? The definition, we can have it in a more practical, understandable way. A gift is something which is procured for the purpose of being gifted, whereas a sample is the one which is my output. Take, for example, a medicine company, a pharmaceutical company. Much of their production, close to say 6 to 8% of their production, is given away as free samples only. Only by giving it away as a free sample to a physician, they will be able to impress upon the physician the quality and the capability of their medicine. Once that is established in the minds of the physician, that will be prescribed by the physician, the doctor, to his patients. Their sales will indirectly increase. So sample, I've given the head-on definition or the head-on situation where sample practically will be having issues. Gifts meant to be given as gifts. Now the arguments that are there for and against is what we are going to dwell on. Gift or sample, generally they are without consideration. So there is no doubt that there is a consideration. No, there is no consideration at all. Is it so? Now, section 2 subsection 31 of the CGST Act defines consideration, and it says any kind of inducement for making a supply is also considered to be a consideration. I'm giving you something free. I'm giving you a gift so that you will remember my company, you will remember my brand, you will remember my product, and I'm inducing you to purchase from me. Can I take that stand? So what I have put forth in front of you are two schools of thoughts. The first school of thought is, sir, gift or sample is without consideration, so no ITC. The second school of thought is, no, the gift or sample itself is a consideration. The gift or sample is given to the other party only to make the other party feel that, see, I'm existing, you can also come to me. I'm giving you a feel of my product. I'm giving you a feel of my hospitality. I'm doing it. Inducement. Two diverse views. The second aspect of gift or sample is there is a call that they call it as it is given in the course or furtherance of business. The gift or sample is given in the course or furtherance of business because it has to be given. Maybe I'm not sure whether it is happening these days. Some 20-25 years back, when we were school children, especially during this Diwali time, we go to any sweet shop to buy sweets and savories for Diwali. The first thing that the parent would do when they take me to the shop is they will say, give some samples to him, so that that will keep me quiet. So they would give a sweet sample and a few savory sample, which I will take, sit in one corner of the shop, and I will keep eating. By the time they will finish the shopping, that sample is an inducement. What is given to me is not out of love and affection. He hardly has anything for that, anything for me in that direction. So what he will do is, if I am able to impress this child, the parent will purchase. So the gift or sample, they can say very well that it is given in the course or furtherance of business. Yes, one argument. The counter argument is, agreed, it is given in the course or furtherance of business, but look at the way it is given. It is an ITC availed goods. What you are giving is an ITC availed good. If that ITC availed goods is given free without any consideration, irrespective of who is receiving, there is no condition in Schedule 1 that when an ITC availed asset is given. Now, when I use the word asset as it is used in Schedule 1, please don't think it is meant only for capital goods. No. Asset is a term which can mean both property, plant and equipment as well as current assets. My inventory is my current asset. So asset is a common term from that perspective. So don't mix it up with inputs versus capital goods. We are not getting into that. Schedule 1 says any ITC availed asset is given without any consideration. It is deemed to be a supply. 17 subsection 5 clause H says anything is given away by way of gift or free samples. The ITC on that is blocked. So we have a double block. Schedule 1 says it is an outward supply, or 17 subsection 5 clause H says it is a block credit. If I follow 17 subsection 5 clause H, I should not take ITC, then Schedule 1 will not kick in because it is not an ITC availed asset, which I am giving free. If I ignore 17 subsection 5 clause H, I avail the ITC, now I am caught by Schedule 1. Hence, I feel gifts or samples, again, it is my personal view, gifts or samples will get attracted within these two provisions. If you ignore 17 subsection 5 clause H, I still think Schedule 1 para 1 will win. And there it will be proved that it is a deemed supply. Moment it is a deemed supply, taxability will get established. No, I will not even take ITC. I will still give it as free. You are free because you have not taken ITC. So when you give it as free, there is no supply. There is no deemed supply. We get out of the matter a key area which we may have to look in, qualify, advise the clients accordingly. Whether section 17 subsection 5 will override Schedule 1 or Schedule 1 will override 17 subsection 5, which is what I told you. Both have a blocking effect. None has to override the other. There need not be. We can constructively interpret both without having the overpowering mechanism, because whether it overpowers or not, the impact is the same. Both go in the same direction. Either don't take ITC or take ITC, pay tax. Both go in the same direction. So why would I even think about the conflict between these two? Now moving to the next practical aspect in ITC is that discount. The moment I say discount, there'll be a lot of questions that will be there. I'll try to, as a monologue, I'll try to give ask the question and give the answer as well, because of the paucity of time as well as the number of participants. Okay. Now, the discount that we are talking about in GST can only be of two types. Either the one which is given on or before making a supply, which is on the invoice. The discount is given on or before making the supply. If it is given before the supply, still it can be incorporated in the invoice. If it is given at the time of supply, still it can be given in the invoice. So it should find a place in the invoice. If this is the kind of discount that is given, there is no problem. GST does not have any conditions. It simply says, go ahead, give the discount. To the extent of discount, you can reduce your price, meaning the taxable value. Section 15, the exclusion in 15 subsection 3 clause A says that any discount given at the time of invoice on or before making the supply, given in the invoice on or before making a supply, can be reduced to arrive at the taxable value. It is an allowable deduction. So we need to pay GST only on the net value after the discount, any amount of discount that is given. Now, the other type of discount that one can face is the most common, or the one which is litigatable: post-supply discount. A discount is given after the original supply has happened. 15 subsection 3 clause B of the CGST Act carries certain conditions which need to be fulfilled to be able to avail this. It is not saying that it is not available. Post-supply discounts are allowable under GST, but subject to fulfillment of these conditions. What are those conditions? There are two in terms of clauses, but if you interpret it, there will be three conditions that will emerge out of it. The three conditions respectively are: one, the discount which I am giving, the quantum, or at least the fact that there is an eligibility of a discount, should be pre-agreed. There must be a pre-existing agreement or a pre-existing understanding. Now, how it should it be in writing? Should it be an email? Should it be an SMS? Nothing is given in the law, but it should be pre-agreed. It should be there when at the time of making the supply itself, it should be clear. Now, how do I prove it to the department that we had this agreement at the time of making the supply itself? Obviously, it has to be forming part of our purchase order or sales order. So no, sir, it cannot form part of my purchase order or sales order. Can I still give a discount? You can, but you will fail to satisfy this condition of being pre-agreed. No, we have agreed previously, but how do I prove it? As long as you are not able to prove, it will not be considered as pre-agreed. Hence, a practical difficulty which has to be overcome by documentation. Second condition that 15 subsection 3 poses is the credit note, that is the discount which is given by a credit note, should be related document wise. It cannot be an ad hoc amount. It has to be relatable to the supplies that have been made in the past. Let's say I have made you 10 invoices in the past, and I'm giving you a say turnover discount because you purchased those 10 invoices, let's say 10 tons from me in the year. So I have already set a target that if you cross 9 tons, I'll give you 10% discount. So now that you have crossed 9 tons, you are placing an order for the 10th ton. I'm giving you a discount of 10%. Now this discount of 10%, I have to give it through a credit note, and that credit note should refer to those invoices. Now here I want to clarify, earlier the GST portal, the GSTR-1, when we are filing the credit note, it used to ask the invoice number reference. And one invoice number reference, one credit note we'll be able to give. And then another invoice also we have to give the same credit note. We will not be able to give it in the same. We have to again give one more credit note. So because the portal was only taking one invoice, one credit note. But this has been removed. 1st February 2019 onwards, the amendment had come, but in the portal now the facility has come wherein I can report a credit note in total. The total credit note can be reported, but the credit note should pertain to various invoices. This increases our responsibility in terms of documentation. The client has given a credit note. We need to find out why. Is it complying with 15 subsection 3 clause B? If yes, is there a documentation which is in line with this? And whenever they are given a credit note, is there a invoice wise breakup for the credit note that is given? And finally, the toughest part, the recipient should have reversed the ITC. Now, how do I ensure I have given a credit note? Now, that gentleman is supposed to reverse the ITC. I have given an invoice for 1 lakh plus GST of 18,000. Subsequently, I am giving a 10,000 rupees discount for this gentleman. It is pre-agreed. It is given for that invoice. Assume. In that case, I'll give a credit note for 10,000 plus GST, 1,800. Now, ultimately, his ITC, which he availed as 18,000 in the first instance when he got the invoice, now it will get reduced to 16,200 because I have given a credit note for 1,800 GST. 10,000 basic value, 1,800 GST. I have given a credit note. Now, in GST, as Ganesh would have told you yesterday, only a supplier can issue a debit or credit note. Other party can issue, but it doesn't have any legal validity in GST. Accounting wise, as we learned in our first year of accounting, maybe +1 or PU1, what we would have learned is debit or credit note can be given by anybody. But GST wise, read with section 34, it says that only a supplier can give a debit or a credit note adjusting the value of supply. And going by that, the credit note which I am giving is going to impact your purchase price. It is going to impact your ITC as well. But how do I ensure that you have reversed the ITC? I don't have the key to it. I cannot do it. But it is one of the expectations of 15 subsection 3. That is why I have seen, especially some of the cement companies in the southern part of India, they are appointing chartered accountants to go and check the books of the dealer whether he has reversed ITC. Because the cement company is giving the credit note, but subsequently they want to ensure that whether the other party has reversed the ITC to qualify under 15 subsection 3 clause B, to ensure that they are even doing a physical check of the books of the dealer to ensure that they are reversing ITC. Can everybody afford to do it? I do not know. But this was inserted. This provision, the expectation was inserted with the GSTR-2 and GSTR-3 in mind, which has never seen the light of the day. And going by the way the things look, I don't think the GSTR-2 and 3 is never going to come. Is not going to come at all. Hence, there might be a necessity for amending it, or in future we will see the restrictions coming in. Because if I report a credit note, it is for the other party to take note of the credit note and reverse ITC. How can I sit and dictate his books? 3 conditions cumulatively need to be satisfied. All need to be satisfied for a discount. And from an ITC perspective, in the recipient's hand, how it will have an impact. Now, before we move further, there is another possibility of a discount. Sir, I'll give a discount only on the basic value. I will not even touch GST. Is it fine? Absolutely fine. That is what is called as a financial credit note. We will never have a problem there. We will see it in this example. I have taken a trading and profit and loss account, very rudimentary. Don't get me wrong here. I'm trying to give it in a very lucid or a very rudimentary manner. In the trading and profit and loss account of a person, we are able to see the opening stock purchases and direct expenses. And on the credit side, let's say he's a trader. There is a sales, and this trader, from his principal, whomever he is procuring, he has got a discount of 50,000 rupees. The fact that I want to throw in further is that the 50,000 rupees, which he has received as discount, was not pre-agreed. A credit note was given for 50,000, but the credit note contained only the basic value. There was no GST. Now, he has availed an input tax credit on the purchase. He has availed an input tax credit on the purchase of 7 lakhs at the rate of 18%. 1,26,000 rupees, he has availed ITC. Now the question is, what is his eligible ITC after having received a credit note for 50,000 rupees? I know it is not right to ask you to give an answer. Maybe you can try giving it in the chat. I will see, say maybe 10-15 answers first. What do you think is the correct ITC? How much he is entitled for? Is he entitled for 1,26,000, or will his ITC come down to 1,17,000? Perfect. This is what I wanted. So everybody, you have given answers, and every answer will have, see, I'm seeing 3-4 different answers. The majority being 1,26,000, which is what is the intention of the law. Now here I want to clarify again. This is something which can be disputed by the officers as well. Now look at the intricacy of accounting here. Had I not shown this discount as an income on the credit side, had I shown it as net in the purchases, Had I shown it as purchases, 7 lakhs less 50,000, 6 lakh and 50,000, what would have happened? Nothing would have happened. My 1,26,000 credit was intact and it continues to be intact. Just because I show it as an income on the credit side does not mean that it is a supply. This 50,000 rupees is an income, no denying that. But is it a supply? No. All incomes are not taxable under GST. Incomes are taxable under Income Tax Act. All supplies are only taxable under GST. It is not a supply. Take for example, a write back of a 20-year-old creditor. I'm just giving a huge, impossible example. Let's say 10-year-old creditor. I'm writing it back. He has not claimed at all. I'm writing it back. 10-year-old creditor. Would I have availed ITC? No. There was no question of ITC at all at that time, especially GST. I'm writing it back. I'll show it as an income. Does it mean that there is a supply? Do I have to pay GST on that? No. There is no impact. Same way here, 1,26,000 stays. There is no impact. It is only an accounting treatment that we are doing by which we are showing this 50,000 as an income. Is there a supply? No. What is this discount then? It is an adjustment to a supply. The supply of 7 lakh has already happened. This 50,000 is an adjustment to that supply. Okay, if it is an adjustment, why doesn't the ITC go down? It doesn't go down because the conditions of section 15 subsection 3 is not satisfied. Hence, it doesn't go down. So this is the impact of ITC on such kind of financial credit notes. But when you are giving a credit note which complies with the condition, ITC impact is there. When you are giving a credit note without complying with those conditions, still ITC should remain untouched because that credit note does not have an impact on the ITC at all. This is the point that I wanted to convey. The same fact was given in one of the circulars issued by the department, but subsequently they rescinded that circular for some other reason. But that circular contained this point also. So the rescinding of the circular does not mean that this point will become invalid. This point is still valid. Sir, what about this 50,000? What should we do with this 50,000? Nothing. This 50,000 is a reduction in taxable value or reduction in the consideration. That's all. Look at the impact of it. I have made a supply to you only to the extent of 6 lakh and 50, but I have paid a tax on 7 lakhs. Should the department be not happy about it? I have paid 18% on 7, but I received consideration only 6 lakh and 50. Department will be very happy about it, should be very happy about it. They should not be worried about the ITC reversal. There should not be any ITC reversal at all. That is the point. This 50,000 is neither an income nor something which will create ITC reversal. Moving to the next part of our discussion, which is the last part, which is on the disposals or exchange. Given a simple case, AB Limited is exchanging an old machinery for a new machinery with CD Limited. And CD Limited, generally they sell this product at 1.5 crores plus GST. Now CD Limited, since they are taking the old machinery from AB Limited, what they desire to do is, I will not sell it at 1.5 because you are obviously giving me your machinery. I will charge you less. I'll give you 25 lakhs as discount and I'll charge you only for 1.25 crores plus GST. Now the point here is this a valid transaction? Is there a problem in this transaction from a valuation and GST ITC perspective? Is there a problem from a valuation or ITC perspective? They are not related parties. Now, I'll tell you where the problem is. There are two supplies in this transaction. How? AB Limited, CD Limited. What has happened is, CD Limited is selling the new machinery at 1.5 crores. No, they're selling at 1.25. But hold on. AB Limited is actually making a supply. AB Limited is selling the old machinery for 25 lakhs. There are two supplies which are happening in this transaction. AB Limited is also a registered person. They are retiring one of their assets. Are they not supposed to raise an invoice? Are they not supposed to retire that asset by raising an invoice and selling it off? Barter is a supply. The definition under section 7 of the CGST Act says any kind of barter, exchange, sale, transfer, leasing, licensing, renting, disposal shall all form part of supply. Barter is supply. Barter is allowed in GST, but you have to pay GST. in case of a joint development agreement, for land, is it not a barter? I'm giving you land, I'm getting building. Taxable. So barter is very much taxable in GST. Sir, it's a scrap sale. So what? Scrap or non-scrap? That is a HSN. Under that HSN, you are supposed to pay GST. That's it. Sir, it's a capital goods. Then go for section 18 subsection 6 reversal. Find out under 18 subsection 6 how much, whichever is higher has to be paid. Should I pay the Are you able to hear me now? I think there was some issue in the audio. Is it clear now? Yeah. I'll repeat that point.
Sir, there is no issue in the audio, sir. Everything is perfect. Some people may have the volume parameter. They are not increasing the same. That is the only thing, sir.
Okay, sir. Fine.
Go ahead, sir.
Sorry, I got lost. Yeah. AB Limited has given the old machinery for 25 lakhs. That old machinery is kept as a capital goods in my books of accounts. Then please follow section 18 subsection 6 and do the reversal.
Video is lost, sir. You can switch on your video.
Video is lost. Okay. 18 subsection 6 governs the ITC reversal procedure. So as per that, calculate 5% for every quarter for which it is used as eligible. Remaining should be shown as ineligible. Compare that ineligible with the GST on the selling price. Whichever is higher shall have to be paid. So that is what should have been done here ideally. So there is a problem. We have seen many such transactions with most of the clients, because take for example, they would have given their old battery from the inverter to get a new battery. They would have just exchanged old tires for new tires. All these tire manufacturing companies, they've even gone for an authority for advance ruling, where they had asked old tires we are procuring, what is it? If you're procuring from an unregistered person, there is no problem. But if you are procuring from a registered person, is it not a taxable supply? He's making a taxable supply. Yes, it is a taxable supply. It has got an impact. Now the issue is, if you do this transaction at 1.5 crores plus GST, numerically we may be right. Because net of it is that only, no sir, 1.5 crores plus GST, 25 lakhs plus GST, anyway net will be the same. We're not doing accounting here. Accounting, yes, is perfectly tallying. But look at GST. Officer will give a notice, aram say after 4 years. At that time, you cannot avail ITC on this 25 lakhs. He will simply say, why did you sell at 1.25? You should have sold it at 1.5. Pay GST on 25. The other party also cannot take ITC because the day is long gone. The other party cannot take ITC. Now the other party cannot take ITC. Still you are liable to pay. It becomes an expense. It hits your pocket. Hence, exchange transactions will have to be accounted both ways if both are registered parties. If one of them is not a registered party, let's say a salaried person is exchanging his car, we don't have a problem at all. That is outside the purview of GST, because the one who is receiving is a registered person. So there it is clear. But if a registered person is giving away something on exchange, it is a supply. It has to be treated accordingly. ITC will also have to be acted upon accordingly. Now, we'll move to the next aspect, which is the GST returns. Now, on the GST returns, usage of an accounting software. As I said at the start, the first part of our discussion on ITC, the niche areas we have discussed, the problem areas. Now we are going to discuss how the returns, how it has to come in, or the data population from your softwares, where we need to be careful, is what we are going to discuss. Now here, whichever software that which we are using, there has to be an alignment from GST perspective. Sir, what do you mean by alignment to GST perspective? Again, practical experience where we have seen ERPs developed for multinational companies, in-house ERP. That in-house ERP will not even have a tax module, or will have a European VAT tax module, which cannot be used in an Indian scenario. We will have to have a alignment to GST law. One, sir, generally used accounting softwares, do they not have alignment to GST law? Whatever is developed within India, I don't have a problem at all. Yes, they will have an alignment to Indian GST. That has to be evaluated. So we are talking about all sort of possibilities. Alignment to GST law should be there inbuilt in the software. Else, we will have to manage it through reports, which makes it a pure manual work. Moment we are managing it through reports, I'm 100% sure there will be a mistake, because copy paste is not an effective way, is not a proper way of filing returns. If it happens through the system, it is fine. Now, don't tell me that, sir, will you not believe people? Will you believe only the system? See, system is like garbage in, garbage out. Whatever I put it in, I know that without missing a single strand, it will push everything. But that may not be possible with a human. A human might miss something. That is the beauty of being a human. So let us learn to appreciate that we want perfect numbers to be reported. We don't want perfect people. We want perfect numbers to be reported. Hence, systems should be trusted. Systems should be evaluated and then trusted. So alignment to GST law should be there in the software. Else, managing it through reports, all I can say is all the best. You are again going back to manual method only, not managing it through reports. Then the rules of the software, the popular software which is commonly used, even those software, the master setup has to be done properly. If the master setup is not done, what can clearly happen is the data will not flow. The data will not flow properly. We will think that we have filed the return through the system, but everything would have flown. No, nothing would have flown. We will have a problem in our hands. How does it happen? Let's look at a situation. When I talk about alignment to GST law, first need that we need to look at is Section 36 of the CGST Act, read with Rule 56, clearly says books of accounts shall have to be maintained every GST registered person wise. That is, if I am having 13 GST registrations across India, 13 different books of accounts shall have to be maintained. And that is the presumption with which GSTR 9C is also created. GSTR 9 pertains to that registration. 9C is not asking you for your overall turnover in India. It is asking you for that turnover which is generated for this GST number, but which has gone into overall income. That is the turnover which is sought in your GSTR 9C table 5A. Hence, the first and foremost requirement, we must be able to maintain books of accounts location wise or GST number wise. Let me put it that way, because within the same state, you might have more than one registration. So I cannot say location wise. I'll have to say that it must be registration wise. Books of accounts must be maintained. We cannot have ledgers designated for GST numbers. So this is Tamil Nadu ledger, this is Andhra Pradesh ledger, but collectively we'll have only one trial balance. Wrong. Data that we pull from there, we will be able to manage, massage the data and give, but it is still wrong in the eyes of GST because you are not maintaining books of accounts for every state. Now, where is this problem going to come? In the GST audit by the department, not by us. In the GST audit by the department, I have seen and heard cases from senior officers of the department that earlier in the VAT regime, the major problem, I'm taking the example of Tamil Nadu. In Tamil Nadu, we have the concept called as VAT audit. In Kerala, we have the concept of VAT audit. Karnataka, we had VAT audit. What it meant was at the end of the year, the returns were filed monthly basis, VAT was reported, sales CST was reported, but total sales had to be reported at the end of the year in one consolidated return called as annual return. That annual VAT audit report. That VAT audit report, when we are filing as a professional who is entitled to do the certification, we mention what is the increase, what is the decrease, all that we are supposed to give. Now, generally what used to happen in the VAT regime is that we will give the turnover of that state and then simply in the next column we will say, that is when we are reconciling their profit and loss account turnover with the turnover for the state, we will say this is the turnover reported in the in the VAT returns, and this is less than the turnover reported in P&L. The difference is other states. We'll simply mention the other difference as other states. Officers did not have the power, or neither they were asked, they had the intention to verify whether what I have reported in Karnataka is right or not. He is only worried about Tamil Nadu turnover. I have reported everything in my returns, and that is what I am showing. And when he asked the reconciliation, I told him this much is pertaining to other states, so he will not bother. But that is not possible in GST, because every state you will have to file the return in the same portal, and the officer can get the data from the portal. So we will have to have the registration number wise books of account, from which we should have prepared the GSTR 9 and 9C. From that only we should have filed the returns. Hence, tomorrow when there is a question, we should be able to give a comprehensive reconciliation. One. Second, alignment to GST law. The records and registers shall have to be maintained location wise. Here I want to purposefully say the location, because especially the movement of goods inventory. The inventory goes out and comes back. Every premises wise records will have to be maintained. I have an office in the city. I have an office in outskirts, a branch in the outskirts. The movement of inventory happens between these two. It is not a supply, but there is a movement of goods. At any point of time, an officer inspects your main office stock. He should be able to see from the inward outward register how much has moved from your branch to here. Same way, he goes to the outskirt branch. There he should be able to see how much has come in from the HO or how much has gone to the HO. Hence, don't think that for a GST only I will maintain stock records. No. The inward and outward registers will have to be maintained location wise. Expectation of GST. And then comes the ITC that we avail on inputs. When we avail ITC on inputs, the point that we need to be careful is inputs are goods. For those goods, we are supposed to maintain inventory. When the doors of input tax credit opened, where people said, come on, let us avail all the input tax credit, because GST simply says what is input? Anything that is other than capital goods, which is used or intended to be used in the course or furtherance of business. Let us avail all the input tax credit, even on the stationery, pen, paper, everything. Perfect, you can avail. But you need to have a movement register. Sir, how will I track pen, paper and all? You said that you have availed the ITC. How will you substantiate to the officer that you have utilized it? You purchased it, whether you have it in stock or have you utilized it? How will you know? How will the officer know? How will you substantiate it to the officer? Hence, any kind of such inputs on which you are availing ITC, inventory interlinking shall have to be there in the accounting. If the inventory interlinking is not there, we are in for a big problem. The ITC that which you are availing on anything and everything, officer can always ask a question. Fine, you have availed ITC on, say, 3,000 sheets of paper. Now tell me how much you have used, how much is pending. Can you say everything is used? Fine. He will simply ask, where is the register? The record to prove that so much was purchased, ITC was availed. Yes, you have it. How much was consumed? How much or how it was consumed? Give me the outward. We should be able to substantiate. So please remember, this is what I meant, alignment to GST law. Now moving to the next part, which is the master setup in GST, especially from an accounting software perspective. This has undergone a huge change after GST, especially after TDS in GST. After TDS and TCS, it has undergone further changes. I'll tell you how. First, you have the same customer, but that customer is located in 3 states. Let's take ICAA. I am a vendor to ICAA. ICAA is located across India. They are registered in all the states or most of the states. Now, I have to create each and every state ICAA as a separate customer. I cannot have one customer. GST number wise supplier, GST number wise customer, because now the accounting software master has to be set up with the GST number as the driver, not their PAN or not their location or not their name. So same customer, same vendor might be there multiple times in your vendor register or in your customer register with different GST numbers, which is allowed, which is what is required. Now I will tell you the practical difficulty here, which unless the GSTN comes up with a solution, we will not be able to resolve, which is the TDS that is done by government departments or the PSUs, public sector undertakings. What happens is we make a supply to them, and after 2 or 3 months, we report it in our GST return in the same month. After 2 or 3 months, what they will do is they will do TDS under GST, and that TDS they remit it to us. But that TDS, they have an option to either to remit it through their GST number, reporting it to GSTR 7, or they might have taken a TDS registration with their TAN. Now, TAN is only one for the whole organization, and they just report it. Now, the problem is I do not know for which state outward supply that I made, they are doing a TDS. I do not know for which invoice they are doing a TDS. Yes, this is a clear practical difficulty. No accounting software can solve this problem. This reconciliation problem has to be solved only by GSTN. They will have to make it mandatory in the GSTR 7 reporting that what is the invoice number for which this TDS is being done. If till they don't make it, we will only be able to know so much is deducted, but we will never be able to know for what invoice it has been deducted. And which is why recently we would have seen, especially in the state of Tamil Nadu, ASMT 10 are flowing. The department is issuing ASMT 10 like say outside every temple there will be a prasadam, no? Like prasadam counter, they are distributing it. ASMT 10 saying, see, so much of TDS is done against your name by this PSU. Why have you not reported that much of turnover? Even if I had reported 10 times the turnover, the notice is being issued. We are replying to that notice. That is because, one, they have not reviewed in issuing the notice, but that is their problem. But can I reconcile it to the PI? We will not be able to reconcile at this point in time. Hence, it has to be maintained outside the accounting software only. This reconciliation will be a pain point, especially for the receivables teams. So moving on to the other aspect, the master setup, the verification and the update should be robust. Why? I'll give you an example. My supplier, if it's going to be a composition taxable person, we will capture it in our master because we know very well, sir, my supplier is a composition person, so I will not get ITC from him. That is why I have captured. Now, how many of us capture whether my customer is a composition taxable person? We may not even capture it, but look at it. Does this resemble anything, or have we come across this somewhere? Yes, we all would have come across this while filing GSTR 3B. Table 3.2 in GSTR 3B. An unfortunate table because it is not mandatory. So we skip. It is not asking for the breakup of all the IGST outward supply that is reported in 3.1. 3.1 being the major table in GSTR 3B where we are supposed to disclose our outward tax liabilities. Now, where in that it is asking for those outward tax liabilities reported in 3.1, especially A, outward taxable supplies. In that, how much of your outward supply has been made, interstate outward supply has been made to 1, unregistered person, 2, a composition taxable person, or 3, an UIN holder, a person who doesn't have a PAN in India but who has been given a unique identification number. How much of it has been made to such persons is being asked. Sir, even if we don't give this data, the system accepts it. Why should I bother about filing it? We should bother because of this. Circular number 89 of 2019. It clearly says if someone is not reporting the data in 3.2 of GSTR 3B, action can be taken by the officer under section 125 general penalty. 25,000 CGST, 25,000 HGST penalty can be invoked by the GST officer. Lucky that I have not seen a single notice so far from the department side. Maybe they didn't take note of the circular at all. Why is it important? Because the tax apportionment as per the IGST Act, if it has to happen, section 1718 of IGST Act, as per that the tax apportionment has to happen, this table must be populated. But accounting software doesn't capture it, or even if accounting software has a potential, we do not key in this data because our customer being anybody, being an unregistered person, yes, maybe for B2C purpose, we will capture. Him being a registered person, whether he is composition or not, we don't capture, or the accounting software doesn't have a capability to capture. There is a number that is given, but that is an UIN holder. It starts with 99 and something. So we think, okay, fine, it is an UIN holder, but we report it under B2B and we think that we have done our part. So we are supposed to distinguish and report it here in table 3.2 of GSTR 3B. The expectation of the circular is also given here. Hence, appreciate the connection between your accounting software and the GST returns. If it is not completely connected, better to take it out and file it. These data will have to be managed individually. And moving further, the few niche areas which can only be addressed in your accounting software is a supply or a sale to a merchant exporter. A merchant exporter notification 40/2017 CGST, where we charge him 0.1 percentage. 0.1 percentage IGST or 0.05 percentage CGST, 0.05 percentage SGST. This data shall have to be captured and has to be reported because it still forms part of B2B only. In B2B only, it will get reported in GSTR 1. In B2B only, it will get reported in, or rather, it will get outward supplies reported in 3.1 of GSTR 3B. But this data is to be reported separately since this requires a special treatment. Data has to be captured separately. There must be a measure to cull out this data separately. Same way, partial exemption sale. There are many supplies. For example, supply to a research association. In those cases, what happens is 5%. Anything above 5% is exempted. These kind of notifications have been given under Section 11 of the CGST Act, because 11 of the CGST Act, read with Section 6 of the IGST Act, gives the power to the CBIC to issue any such notification, giving conditional partial exemption also. So they have given conditional partial exemptions which are there. For example, the research institutions. When I'm giving any supplies to them, anything above 5% is exempted. So up to 5% is taxable. Generally, I'll be selling that product at 28%. Generally, I'll be selling it at 28%. But now this supply is only 5%. Has to be captured separately. Has to be reported. The rate-wise reporting must be there as part of my accounting software to capture this, because it will go a long way into my GSTR 9C also for reporting the rate-wise sale. And the other most problematic area is whenever I make a sale to my customer rejects any part of it. Fine, there is no problem. But he doesn't reject expecting me to give a credit note. He rejects it and gives me an invoice. I make a supply to my customer rejects it. If he is going to reject it and send it plainly through a delivery challan, I will give a credit note. So my books, stock will get increased, sale will get reduced. But what is happening is, the larger the organization, the customer is going to be a big customer. The customers, they have decided that let us not wait for the credit note from my supplier. I will send the goods out with my invoice. So they are raising a tax invoice and sending those goods. If they are raising a tax invoice and sending those goods back, now how do we account it? Does our accounting software have the capability? Because when it is being sent back to me, should I account it as a purchase? Wrong. It should be accounted as a sales return. But in the eyes of GST, it is an inward supply because you have to take ITC on those returns. You have to take ITC on those returns. The classic example I would give, which the department also has prescribed for medicine, pharmaceutical companies, they have given a specific circular on this in 2018, stating that pharmaceutical companies sell medicines with expiry date. Let's say after the expiry date is over, the medicine will be returned by the dealer to the pharmacy, the pharmaceutical company. He will return it. When he is returning it, can the pharmaceutical company give a credit note? No, because already the time limit for issuing a credit note, which is 30th September of the following financial year, would have already gone by. So I cannot give a credit note. So their department themselves have suggested in that circular, do one thing, whoever is the pharmacy or the dealer who is returning it to the pharmaceutical company, you please raise a tax invoice and send it back. Don't give it as a credit note, because giving it as a credit note is not allowed. You cannot give a credit note back. But what you can do is you can make an outward supply, because in GST, outward supply, inward supply, only two types of transactions are there. Not all outward supplies are sales. Not all inward supplies are purchases. My sales return can also come back by way of inward supply. My sales return can come back as inward supply. Now, this is commonly happening, especially in automobile industry. Be it the Kia Motors or Hyundais or Tatas, they all do this by way of returning it by way of an invoice. When I'm getting the return by way of an invoice, will my accounting software be capable to report it as an inward supply for GST, but a sales return for the purpose of my books of accounts? Here, we will have to see how the system is able to behave, and accordingly, the returns will have to be filed, because I have seen many people wrongly filing. They don't take it as ITC. They go and reduce it in their outward taxable supply, which is wrong. Because if it is returned by way of a tax invoice by my supplier, I am entitled to take ITC only. I cannot be raising a credit note. Sir, let him return by invoice, sir. I will raise a credit note, sir. Now you are doing double time. By raising a credit note, you are reducing your liability. He has already given a tax invoice. So you will avail the ITC, or even if you don't avail the ITC, that is ITC is available in your 2A. He would have paid the tax liability. Now you are punishing yourself twice. Hence, this part of the problem, whether it is addressed accounting software, please note. And then the other issue or the niche areas that one has to look at is export related transactions. In case of export related transactions, the shipping bill, the port code, these details which are required for the purpose of GST return, is it being captured? And then the other pitfall that we have seen is, especially when we go and stand for refund, the foreign exchange. Rule 35 of the Rule 34 of the CGST rules states that in case of goods, the foreign exchange shall have to be adopted at the rate at which it is notified by CBIC. CBIC gives a notification for the purpose of customs. Section 14 of the customs purpose, they issue rate notifications. We are supposed to take that. Most of the MNCs will have something called as group rate. So their accounting software will be running at group rate. But GST will have to happen, or the reporting under GST will have to happen at the rate at which the customs notifies. That is how it should happen. Then only your shipping bill value of CAF and FOB will match with your books of account CAF and FOB. So there is an underlying forex accounting issue. See whether this has been addressed in your software, and because of this there is no difference that is arising in your reporting. Moving to the next aspect, the rules of the software. As the chairman of Vijayawada branch at the start said, if everything is through the software, it will be easier. But is everything going through the software? For example, if I am raising a sales invoice, if I am raising a credit note, system will be able to recognize it. But if I am passing a journal for a particular ledger, will the system recognize by journal? Will it include the journal impact in its GST returns, which is being filed through the system? Is a major question mark. So we should be evaluating such accounting adjustments, which I am doing. Such accounting adjustments, it should be very clear that it should either be taken by the system for the purpose of GST filing, or it should not be taken by the system, because there are certain journals which I will pass only for the purpose of closure entries, that is offset entries. I will take the input tax credit, meaning credit the input tax credit ledger and debit the output tax liability to knock off the payment for the month. Now, why should that entry go into the GST returns? It should not go. How do I brand it? How do I keep it aside from what is being populated in the GST return? Is there a capability? That has to be evaluated while we are filing the returns through the system. And then the data capturing point. I have seen many people passing only journal entries and giving us the ITC ledger and saying that this is what is the ITC ledger. We will never be able to derive data from it. No, those are the data capture points, which one, we will have to get accustomed to the client, or educate the client in such a way that he gets accustomed to best accounting practice, so that we will be able to come out, resolve the issues pertaining or that is surrounding the filing of returns. Moving to the next part, the reconciliations that one has to perform under the current GST procedure on a macro level. Let us look at the first part is my books of accounts. Now, what am I doing here? My books of accounts is the one which is the source for my GSTR1. It should be the source for your GSTR1. And then I have a GSTR3B. My GSTR3B is fed from my GSTR1 as well as from my books of accounts. So my GSTR3B gets populated with data from two sources. One from GSTR1 and the other one from my books of accounts, because outward liability part will only come from GSTR1. My RCM and ITC shall have to come from my books of accounts. My GSTR3B is done. Now, the next element which we are all currently going through, GSTR9. I'm not bringing 9C into the picture at all. I'm assuming a euphoric situation where 9 itself is matching perfectly. So 9C, there is no qualification, nothing. So if I have to prepare a Pakka 9, what am I supposed to do? This 9 that I am preparing should directly be in line with my books of accounts. And then it should have the delta changes. That is GSTR1, there are some changes, sir, in my GSTR9. GSTR3B, I left out some changes which I need to do in my GSTR9. These can be taken care in GSTR9. So it is not that GSTR1, GSTR3B should be GSTR9. There can be. The department is accommodative as per the annual returns, the press releases that they have given, that report only what is as per your books of accounts in GSTR9. There is no problem. But what we report as books of accounts should have already been covered in our GSTR 1 or 3B, especially 3B, because tax liability should have been settled in 3B. Had we not settled, now it is the time to settle it in GSTR 9. So the reconciliation cycle, the chakra view of reconciliation is this: books to GSTR 1, books and GSTR 1 feeding 3B, books feeding GSTR 9. 1 and 3B also have a role to play in GSTR 9 by way of corrections to those being performed in GSTR 9. As a chartered accountant who is keeping track of the assessee's information, what we are supposed to do is the changes to GSTR 1 and 3B which impacts GSTR 9. Sir, what is reported in 1 is only taken in 9. We don't have to do any exceptional reporting. What is reported in 3B is only taken into 9. We don't have to do any exceptional reporting. But what is reported in 1 and 3B is not matching with books of accounts, then the delta, the difference between these will have to be addressed by us, will have to be identified, documented, reported. It may result in a liability, it may not result in a liability. That is where 9C comes into picture, which is what is our responsibility. Now, moving further, when we look at the outward reconciliation, some of it might be a repeat of what Ganesh would have told you yesterday. Still, quickly we will go through it. If we are sitting and doing an outward reconciliation of the outward tax supply value as well as the tax liability, we are supposed to broadly classify, or the source has to be dug up. The source documents, which I have given in orange color, the third column, invoices, debit notes, credit notes, the receipt voucher or the refund voucher, because receipt vouchers will have tax liability on the advances, or in case of exempted goods or services, it is bill of supply. From that source, we'll be able to segregate as to whether it is taxable or exempted or nil rated. And from that only the outward taxable supply and tax liability will have to be arrived at. And this is how, if we do on a monthly basis, we'll be able to easily come out with a reconciliation for the purpose of the annual return as well as the financial audit also. The only other classification that we would be forced to do as a reconciliation or maintain a data point is how much is B2B and how much is B2C, which is easily obtainable from the masters. Had we configured the masters properly, yes, this will automatically happen. Nowadays, the problem of SEZ is gone, because earlier the supplier would have been SEZ, but we wouldn't have configured as an SEZ in our system. We used to file as B2B, then we will do amendment. Nowadays, what happens is when we are filing it as SEZ in the system, in the GST portal, an SEZ as a normal person, system will not accept. It will automatically tell this is a SEZ GST number, so please correct it. So that way, back updation of our master shall also have to happen when we do this outward reconciliation. Now we move to the next part of the reconciliation, which is looking like this. Now, this is what most of us would have done for the annual audit. The client has got 4 registrations: Tamil Nadu, Andhra Pradesh, Telangana, and Karnataka. All the places 1 lakh respectively is their outward taxable supply. Now, the total turnover is 4 lakhs. I have seen this happening. 4 lakhs signed balance sheet P&L, submitted to ROC, income tax, everything, 2017-18, 2018-19. But unfortunately, what the auditor should have done, the financial audit should have done as a reconciliation is this: 1 lakh in every location does not mean it is a sale. It could be a deemed supply. There is an element of 2.5 lakhs worth of stock transfer that has happened between one registration to another registration. That should have got eliminated. So if you are having 4 state registration, 5 column trial balance shall have to be prepared like this. Then only the outward reconciliation is complete. This is the reconciliation that I spoke about earlier, because unless we do this, we will never be able to tell that this pertains to this state. Tomorrow there is an audit for Tamil Nadu. I cannot say, sir, Tamil Nadu is 1 lakh, sir. Remaining 50,000 is there, no? Because the total is only 1 lakh and 50 as per P&L. I will say, sir, remaining 50,000 is other states. I cannot say that. If I say that, the officer has got the right to ask me, now tell me what is the reconciliation for the other states. If I am not the GST auditor for other states, I can simply say, sir, see, this is the books of account for Tamil Nadu from which I have derived this. And I have given this. Now you please check with the other states for them to give the data, or check with the statutory auditor. I am only the GST auditor for this state, but the statutory auditor is a different person. That is the reason why in our GSTR 9C certification, we are giving the statutory auditors GST number, statutory auditors name and their firm details for the purpose of the department to check back. So these information are not there without any purpose. They are there because we are supposed to do a cumulative reconciliation. So I am doing only one state GST audit. How am I supposed to handle? Very simple. Please tell the client that please give me a certified trial balance from your statutory auditor. That is what is enough for me, because I will assume that this is what has gone into consolidation. Now that certified copy is what I will compare with the returns filed for this particular state, and I'll be able to come out with the reconciliation. So this is one of the key points. As I said, multiple times I have seen in 1718 and 1819 this elimination not happening. When questioned, the statutory auditor has come back to me saying, what is the problem? I've shown it as purchase also, I've shown it as sales also. Anyway, the net impact is zero. Again, we are not talking accounting here. Net impact is zero, I agree, because it is mathematics. Here it is an increase, here there is a decrease. But please tell me, for your banker, you would have shown a turnover as 4 lakhs, but your actual turnover is only 1.5. Is there not a fraud there? That is what is something which is even more detrimental. Hence, this reconciliation can weed out such unwanted issues as well. Outward reconciliation, GST wise trial balance. Now moving to the next aspect. Don't worry, I've tried conveying something through these pictures. What I have tried conveying is, on the left hand side, you are seeing a video. It is not a video, it is not a running video. I'm saying that it is a videography that is happening. On the right hand side of your screen, somebody is doing a photography on a tripod. What connection it has got with input reconciliation? This is the connection. GSTR 2A is a video. GSTR 2B is a photograph. Okay, what am I trying to convey here? GSTR 2A is a video means it gets constantly updated. GSTR 2B does not get constantly updated. It means on one particular day, GSTR 2B will be cut off. So it is like a snapshot. It will take a snapshot, that's it. That month's GSTR 2B will never change. I'll repeat, that month's GSTR 2B will never change. So anything reported after the date, after the snapshot, will all go and get reported in the next month 2B. How does it happen? Let me give an example. Let's say for the month of October, sorry. Yeah, for the month of, why is the video going off suddenly? I don't know. Yeah, for the month of October, yeah, it's working. Just a minute. For the month of October, one person has filed, that is my supplier has filed the return on 10th November. My another supplier has filed the return on 13th November. October 2020 ITC I have to take. One of my supplier has filed the return on 10th November. Other supplier has filed the return on 13th November. What is the big deal? In between, on 11th midnight, GSTR 2B snapshot will be taken. So what will be the impact? This 13th November reported invoice, I cannot include it in my ITC eligibility for my October filing. I'll repeat, the 13th November reported, sir, but he is only filing GSTR 1 for October only, no? But he is filing it on 13th November. Doesn't matter. He is reporting it after 11th November, which is the due date for filing GSTR 1. Hence, this credit is eligible for me, but this credit will go and sit in my GSTR 2B of November. So as at the end of 11th November, whatever has been reported, that will only appear, or that is only entitled to me in terms of my input tax credit for October. So my supplier's reporting is going to have a serious impact on my GST ITC. That is what is 2B. The reason for 2B is, as I have shown you earlier, it is a photograph. Because earlier, what some of the assessees were enjoying, which also we will have to sensitize to our clients, is that till 19th midnight, whoever is filing GSTR 1, all that we will take into consideration for calculating our ITC eligibility for filing it on 20th. But that may not be possible from now on. From now on, I mean from 1st January 2021. That is from the date on which it is going to be implemented, GSTR 2B. From that day, ITC that is reported only up to the cutoff date against our name will appear in 2B, and that is what we can avail as ITC in our GSTR 3B is going to be the major change, a difference between a movie and a photograph. And GSTR 2A, even currently it is showing all this data, but they have notified that it is going to continue the same way in the days to come. That is, GSTR 2A is going to contain all our B2B, which is already happening, all our debit notes issued by our suppliers, all the credit notes issued by our suppliers. Yes, plus it is also going to reflect, it has already started reflecting bill of entries filed with the customs. The bill of entries filed with the customs are getting reflected in GSTR 2A straight away. We are able to see even SEZ. We are filing a bill of entry and removing the goods from SEZ. That is also getting reflected in my GSTR 2A. We are able to see, and then ISD, input service distributors, they are reporting, and that is also getting reported in GSTR 2A. It is also reflecting in GSTR 2A. So these are the only possible methods through which a person will be able to take ITC, apart from the reclaimed credit, which I spoke at the start, Rule 37. Apart from reclaimed credit, the ITC for a normally business doing concern can come only from these 5 areas, which is now plugged by GSTR 2A as well as 2B. This is what is going to be dictated for us in the future. So the 2A reconciliation is now going to become outdated. 2B reconciliation will become mandatory. Because last month invoice, I have booked it in last month, but my supplier reported it only on 13th November. So I cannot take input tax credit for this month. So I will have to have a segregation within my ITC that ITC booked in this month, reported by him belatedly, so availed in the next month. Second category, ITC booked in this month, not at all reported by him, start following. Third category will be ITC reported by them within the time, which I have also booked, which I have also taken ITC. So that need not be followed up. So this segregation will have to come. And this 2B is going to come with another features or another expectations from the accounting fraternity. The ITC will be auto-populated as on the snapshot date in our 3B, which is what they have notified. Now, the major gearing up the industry will have to do is what I have given here. Ineligibility in ITC should also be accounted. What do I mean by that? I've given a simple example. For our staff, we have purchased 10,000 rupees worth of food, paying GST at 5%. Now, what we will do currently is we'll pass this entry because we know very well, everybody in GST will know that, sir, food and beverage, there is no ITC. As long as you don't make further supply of it, fine. So book it like this. Expenses, staff welfare 10,500 to bank 10,500. But once the 3B comes into picture, rather once 2B comes into picture, what will happen is this 500 rupees also, the other party, had he taken your GST number, he would have reported it in his GSTR 2A. Since he is reporting it in your 2A, it will come in your in his GSTR 1, it will come in your GSTR 2A, 2B, both. We are answerable for that. So how am I supposed to account for it? Now, when I advised one of the clients like this, I told their CFO took me to the accounting person, and he said, inform this team. 3 people were there, they were doing the bill processing. So I told them, you please pass the entry like this. The entry is staff welfare 10,000, GST expense, because it is a blocked credit, 500 and to bank. She asked me, sir, why should I pass this entry? Because this 500, if you put it in GST expense, it can be extracted as a report and we can match it in 2A. See, 2A, whatever is matching is not eligible. Whatever is matching is matching. We have to go through the second filter. It is matching, but is it eligible? Only if it is matching and eligible, we avail the ITC. It is matching and ineligible, it is matched. That's all. We are supposed to do a matching because 2A, 2B reconciliation we'll have to do. So this 500, where will I get the information if you account it as 10,500? So please account it as 500 separately. Now the CFO said, no, Shankar, we cannot do it like this. Why? Because how will I have an expense account in my P&L called GST expense? Where will I take it? Which cost center I will apportion it? We have that problem. Then I told him, sir, do one thing. Pass an entry like this. Staff welfare to bank 10,500, but give me a self-balancing ledger. GST expense debit, GST block credit debit, GST block credit credit. It is net is zero. There is no impact. But I would have got the necessary information in terms of how much of the credit during the month I have suffered that ITC, but rather I have suffered that GST, but I'm not entitled for ITC. This I'll be able to match with my 2A, 2B. I'll be able to report it. So hence I asked them to do this. That accountant was very, very unhappy with me because she said, you are now increasing my burden by passing 2 more lines of entry. And this has to be done for every ineligible input tax credit, because anything where you have given your GST number to the counterparty, he will report it in GSTR1. If he is reporting it in GSTR1, you are supposed to acknowledge it. You are supposed to take it in your books of accounts, and then you will say it is ineligible. Then you will say it is reversed, but you are supposed to acknowledge it. This is the way to acknowledge. This is the way to do matching. So this change will have to happen in our accounting, even while doing the basic accounting. Moving further, where there is going to be a common input tax credit scenario. Rule 42. As I said at the start, I'm not going to go deeper into it. Just a quick look at the input, the Rule 42 input tax credit, where we are supposed to apportion the credit between exempted and taxable turnover. Now, this cannot be done at the invoice level. We have to take all the input tax credit, then do the reversal in GSTR 3B. Table 4. We are supposed to do it in that specific line for Rule 42 and 43. For that, we have to first ascertain out of the total ITC that is available to us, how much is ineligible, and on the remaining, we should identify how much is specific credit and how much is other than specific. How to find out other than specific? Find out specific. Balancing figure will be other than specific. Now, specific to what? Specific to taxable turnover, specific to exempted turnover. Specific to taxable turnover, that invoice fully you can avail ITC. Specific to exempted turnover, full ITC is not available. So there is no proportion there. As long as I'm able to specifically identify it, what is specific to taxable is only available. What is specific to exempted is not available. On the other hand, the credits which are not specific only, we are going for a proportion. So here I want to impress on you one more time. The proportion is not here. That is on the total ITC. The proportion is here only on the common ITC. The proportion is only on the common ITC, which cannot be attributed to specific. There, proportionate to taxable we avail, proportionate to exempted we reverse. So we have to take all the ITC that is coming our way and then do this reversal. But currently, people do this segregation while accounting itself. Sir, it pertains to exempted, hence I did not even avail, sir. We cannot do that. We have to avail and then reverse. Please bear this in mind. Rule 42's impact at a later point of time. We will spend a lot of time only reconciling. To avoid it, fix the problem while accounting itself. Rather than reconciling, correct the accounting itself. Then we'll be able to come out with the numbers that are required, because we already have some other reconciliation that needs to be done. 2A, 2B reconciliation with books, that is already there. So why complicate with one more reconciliation within the books itself? Hence, the accounting for all the GST should happen. Wherever GST is seen in invoice, that should happen in my books. Wherever I have given GST number to the other party, that should get accounted. Then you classify it as blocked. Then you classify it as ineligible. Then you reverse it. That is second step. Moving to the next part. Rule 42's reversal will have to be done 13 times during the 12 times during the financial year, once after the end of the financial year. So this is the expectation of Rule 42 sub Rule 2, which we are supposed to do, especially for those assessees or clients who have both taxable as well as exempted as their output. Every month, proportionate reversal will have to be done. Plus, at the end of the year, taking the total year turnover, total year ITC, we are supposed to do this reversal. So this calculation will have to be done 13 times. Every month once with that monthly numbers, plus together for a year at the end of the year before September of the following financial year. This is a laborious exercise. Hence, avoid this reconciliation by bringing the numbers, because this itself is a calculation that we have to do. So avoid reconciliations here. And then the GST portal reconciliation. Now, what is there in the portal which I need to match up my books with? Electronic credit ledger, electronic cash ledger, electronic liability ledger. Most of the organizations, I see this electronic cash ledger not even represented in their ledgers. It will stay somewhere. Maybe when they make a payment, it will stay in the debit side of the liability ledger. They don't even recognize it as a cash ledger. Whenever they make payment, they think that it is a payment made to government against tax. It is not a payment made to government against tax. It is like a bank current account. You are moving the money there. It is still there. That has to have a representation in your books of accounts. That has to be reconciled. And these numbers should have to match with your books of accounts. At what frequency we have to do? Bigger the organization, easier to do on a monthly basis. Smaller the organization, at least do it on a yearly basis, or must be done on a yearly basis, because there is one more complication that is coming our way. 31st March, when we are closing the books of accounts, there will be an ITC, there will be a liability, there won't be any cash ledger balance. Now, some companies will knock it off. They will knock off the ITC and show only the remaining as payable. Some people will not do it. What is ITC will remain as current asset, what is liability will remain as current liability, and if they have an excess balance in cash ledger, it will remain as current asset. Now, how am I supposed to report it? We are supposed to take a stand as on 31st March, not as on 20th of April. March return is going to be filed only on 20th of April. So don't try to align to 20th of April, align to 31st of March. We are free to allow the ITC also to exist on the books, allow the liability also to exist on the books. Or if the client wants, no, I want to knock it off and show only the net liability, show it, but separate ledgers, which I am sure that yesterday Ganesh would have impressed upon you. Separate ledgers for credit, cash and liability has to be there in the books of accounts, because these are there in the GST portal. These will have to be reconciled with the corresponding ledgers in our books of accounts. And as on 31st March, we have to take a call. Are we going to report on net basis or we are going to report on a gross basis? Because so far there is no guidance or expectation from the institute also in saying that this is how it should be reported. So we are free to report it either on a net basis or a gross basis. That is up to us. Because especially when it comes to RCM reporting, this can be a bit of a challenge. And now to the last part, the input tax credit register. What is an ideal input tax credit register? I don't have an ideal input tax credit register, but an ITC register, if it contains the columns that which we are going to discuss now, I think should suffice the purpose. I'm not adding the inventory details here, meaning the quantitative details are not discussed. Now I'll have to have the supplier's name, GST number, his document number. So those are the 2, 3 and 4 columns. His date of invoice, not my booking date. Date of his invoice. Date of payment, the date on which I have made the payment to him. If I'm making payment in tranches, one invoice, I have paid 50% and then 50%, 2 times that line should appear here. And then I should have a type. What is the type of ITC it is? Is it an input or is it an input service or is it a capital goods? That segregation has to come here in my ITC register itself. Then the subtype. What is the type of this ITC itself? This ITC, is it on a normal charge, that is forward charge? He is giving me an invoice, I take ITC and subsequently he will pay the tax. I will pay the money to him. Normal charge. No, it is under reverse charge. Then I will be entitled to take ITC only after I make the payment. So that has to be segregated. That has to be captured as a subtype. And then is it imports? Because if it is going to be imports, I pay the tax. Whether I pay to him or not, it doesn't matter, because bill of entry is the document which is making me eligible to take input tax credit, not his invoice. So that has to be captured separately. So line wise, this data, this combination will have to be captured. This is only the first part. Now continuing with the second part, due to space constraints, you will have to assume that after subtype, the next column will be expense head. So why do I need this? I think if you remember GSTR 9C table 14, it is asking for expense headwise ITC. So hence remember, expense headwise data is required by the department. Sometime they will ask in future, better to capture the data. Under which expense head? This also serves one more purpose. If it is not expense head and if it happens to be a asset head, then we will be able to know that it is a capital goods. Why the assessee is saying that it is an input? We will be able to have a check there also. Percentage of tax required to ascertain whether the ITC availed is proper. And then HSN, SAC as they call, but HSN is the common term that we use, which is mandatory, which is going to become even more mandatory from 1st April because they are going to increase the number of digits also. Please bear that in mind. The CGST, SGST, or IGST, the taxable value, these will have to be captured. Total invoice value, these are rudimentary. So the last 2 columns are what I think we should also insert it as part of our input tax credit register. Is it matched in GSTR 2A or 2B? 1. Second, if it is matched, it is availed in 3B of which month? It is matched. Take the same example of my October invoice. October invoice reported on 10th November, matched ITC availed for October itself. October invoice reported on 13th November, matched, but I can avail only in November return. Subtle difference between these 2 columns. These will have to be incorporated. Then only our input tax credit register will look comprehensive, where we will be able to address most of the data. I'm not saying this is a foolproof input tax credit register. This is something which we have been able to evolve and with which we have been able to address the requirements of the department so far. And then finally, the control areas, the key areas where we may have to act upon as the advisors to the business is the compliance reporting of the supplier, whether the supplier is filing the returns, filing the documents within the due date will have to be highlighted. It has to be either taken up by the assessee. Sir, I'm only an auditor. Why should I tell him that? Maybe you, for an internal auditor, you can tell. You are a consultant, you have to tell to the client that please track your supplier's performance. If he is not reporting properly, if there is a delay from his side continuously for 3 months, he is not reporting, blacklist. Because he is not going to pay. If he is not going to pay, you're not going to get ITC. How will I even be able to sue a person who is not paying GST and get recover it from him? I may not be able to. Hence, this has to be kept in mind. Maybe something like KYC in banks, which went through a huge data collection exercise by the banks in the last 10 years. Maybe a KYS, know your supplier. Benchmarking will happen in GST. Maybe that can pan out as a practice area also for us. And another advice to the clients would be to have a specific damages clause for non-reporting or delay in reporting shall have to be incorporated in the PO with the suppliers, because him reporting 1 day delayed may have a dent in my working capital. The credit availment for October can become the credit availment for November. There is a delay. Now, why should I face the delay? Why don't you be held responsible for the delay, the loss of interest? This may have to be taken up as a control area where we can advise to the clients. And finally, the type of registers and records that Rule 56 expects to be maintained. I've given all the registers. Not all are applicable for every assessee. Manufacturers, the production or manufacturer of goods records will have to be maintained. If you're a service provider, the service supply register will have to be maintained. Purchase register will have the purchase details. Sales register will have the sales details. Now, what you can do is you can incorporate your tax liability details in the sales register. You can incorporate your ITC details in the purchase register. So it will cater 7 and 8 also, meaning the 6 and 7 requirements also can be catered in 3 and 4 itself. Stock register will have to be maintained. Import of goods, separate register, separate details will have to be maintained. Export of goods. Sir, there is no separate register, but I can always extract it in Excel separately from the software. Then it is fine. It is as good as these registers are being maintained. Inward supplies on which I am liable to pay GST under reverse charge shall have to be maintained. My outward supplies on which the other party is liable to pay under reverse charge. Let's say I'm a GTA. I'm a registered GTA. My outward supply, my recipient is liable to pay. That register should also have to be maintained. Sir, it is going to anyway come as part of my sales register. Then no problem. 11 need not be maintained separately. And finally, if you are a service provider, especially any advance received and paid must be maintained as a separate register. If you are a good supplier also, it is better to maintain this register because register is still not done away with. Tax liability on advance for goods only is done away with. So these are the basic registers and records which will enhance our process of reporting reconciliation under GST. I know that I have taken a little bit of extra of your time. Apologies for that. And also thank you for your patient hearing so far. Since the numbers are huge, I don't think I'll be able to take any questions. I'm giving the baton back to the organizers. Thanks a lot, all the participants, for your patient hearing.
Thank you, sir. Thank you very much for the marathon way of explaining the thing going on because it is very difficult to generalize a topic like this to explain the reconciliation part, input tax ledger, vis-a-vis the things and all these things. I understand your problem. Actually, anyway, you shared your number and also your email ID. So if you have any doubts, kindly contact sir so that he will take care about those things. Thank you very much for enlightening us in various aspects of the GST, input tax credit and reconciliation part. And friends, thank you very much for your patience, patiently listening and all these things. And tomorrow we are going to start the session by exactly 6 o'clock. Please be on time. Thank you. And we'll have tomorrow message from our Central Council member Rajendra Kumar sir, Chairman Indirect Tax GST and Indirect Tax Committee. Tomorrow by sharp 6 o'clock, just 10 minutes thing will be there, and after that we'll continue.